right, welcome to Vol Stars, where we talk everything markets and those who make them. Today's episode is brought to you by OpenAI. Why earn 1 trillion when you could just convince people you're worth 1 trillion? At OpenAI, we are the leaders in providing IOUs, letters of intent, memoranda of understanding, non-binding joint venture agreements, term sheets, heads of agreement, and stock-based transaction scheme that gets you all the value with none of the work. Don't let your memes be dreams. Get started today by going to chatgpt.com and asking who's the prettiest boy on Wall Street. Spoiler alert, it's you. And finally, by GammaStrike.com, providing actionable real-time data for every type of trader. You've tried the rest, now try the best, GammaStrike.com. I'm Jay Fresh, and I'm joined as ever by our co-hosts Gherkin and Dork, and let's go ahead and get into the market overview. And yeah, so we've got a lot to talk about today. First, I think we should probably include a disclaimer with that one that was parody, and I don't want to be sued for libel.
Satire.
Parody and satire are lumped in the same law, I think.
Yeah, pretty much.
Yeah, so we've got the government shutdown. We've got a lot of other things going on as well. It's not on the list, but I kind of want to talk about the OpenAI thing and all of the agreements that are going on in the context of why is the market falling for it so much? Or are they? Or what's going on? Why is there so much price improvement on these stocks with these agreements that everybody kind of acknowledges right away are not real, at least not yet. They're aspirational.
I'll have you know, a letter of
blurbs.
intent is a formal handshake, okay? They shook hands in public, formally.
Was there pinky?
Yes.
Can you confirm that?
I have my sources looking at it right now.
Okay.
U.S. market forecasting is long run on the idea of the IOU, and so I don't think, as far as business practices go, that the AI circle jerk is any different from things we've seen in the past. However, yes, it doesn't generate market cap right now, and the market cap that it has generated, like almost $1 trillion of market cap in the last couple of weeks, between Oracle, Nvidia, AMD. But yeah, is kind of unfounded. It's purely speculative, and nothing is being delivered and nothing is being bought. But these companies are willing to give up shares of their corporations to be involved with this idea of OpenAI, which is maybe not ever going to be a company. We don't really know because of the status of their nonprofit, and there's some issues with California court regarding how they managed to break off their profitable arm and actually IPO it. So, and until that happens, I mean, there is no deal. I think it's more that people are pricing in the aspirations of the corporation than they are any actual substantive value. And so, yeah, it's likely. We've seen them all run on the news, but I feel like it's kind of a buy the rumor sort of thing, because once the actual deals go through, it's almost like the AMD and Nvidia and Oracle, they're all carrying the weight of OpenAI's future valuation. And when OpenAI actually IPOs, if they ever do, then that valuation would be fed back towards OpenAI. So it's kind of like, I mean, you get this every once in a while where nobody in the market knows what to buy to capture the value in something, and so they just buy the next best thing or the closest thing. And I think that's what we've seen happen here.
Huh. Yeah, that's kind of interesting because if you add up all of the agreements I think it's around $1 trillion in agreements. And so, yeah, everybody's pricing in the full revenues of all of these companies together. But they're all revenues to each other. So I'm not sure how that works, but it's all priced in for sure. All right. So we've got to have an update with the government shutdown. And we should say, because we're recording this a day later than we normally do, we actually do have clarity on last week's stupid bet.
We do.
Yep.
It's not like I intentionally didn't show up to record last night because I wanted this episode to include the conclusion of that bet or anything. I would never do something like
today
that.
Is day 8.
Well, today is day 9.
Is it 9 already? God,
well,
nobody cares.
I mean, it's past business hours at this point, so yeah.
Oh, yeah. Okay. I'll give it to you.
I mean, I don't think the Senate's going to meet after 5
win
p.m.
and Dork loses. I don't know what you lost.
We do.
You lost something.
You had a 99% chance to beat us.
I will say, I mean, we talked about how last week, we talked about like the rollout of pain and how like there's very little pain early on. And so it really matters, week 2, week 3, that's when things start getting serious. But that being said, what I did not expect was to go into my news app looking for, just the latest on it and not having it like streaming over a banner with like a live update thing. I had to go into like sections to find discussion about it, which I don't think that happened on any of the last shutdowns. Maybe I'm wrong.
No, it was definitely top of the news cycle. I think the press and most of the government officials that have spoken on this really don't see an end in sight. You have an untenable position on the Dem side. You have an untenable position on the Republican side, and I'm not going to lie. I think this one could go on a very, very, very long time. And there's a lot less pushback from federal employees, at least in a lot of Democratic districts, because of all of the firings earlier in the year due to Doge and their efficiency cuts. And so, you have a smaller contingent of people that are going to be complaining, and then a smaller contingent of people are going to be complaining vocally. And so I would say that yeah, I mean, I think this we're probably in this shutdown for the long haul. What I will say, to follow up on that though, is that much like we talked about last week, the longer this goes on, the more and more uncertainty builds. Now we've got all that labor data that hasn't printed, and we've got import-export prices that haven't printed, and then we've got weekly labor data that hasn't printed. So now our like week over week unemployment information is the spread between where we think it is and where it is just going to start widening coming up. CPI, PPI. It's a very big deal missing those reports, especially for a Fed that seems still kind of split. And we'll get into that in a minute, but
yeah, I was about to say I'm the transition guy.
I saw the transition, but then I didn't want to skip anything.
I was gonna let this one slide, but you would have heard about it later.
It was so smooth, though. I was just ready to go.
It was pretty smooth. I was thinking like maybe we should bump this up ahead of the other thing because of how smooth of a transition it was. But now that we've talked about it, we can't even discuss that point at all. So we just have to pretend it doesn't exist. No.
Yeah.
I mean, go. So, I mean, that's an interesting thing, right? We've got a Fed that claims that they are data dependent. I would strongly disagree with that. How could you possibly claim to be data dependent when your proposed outcomes spread is larger than just throwing darts at a dartboard, right? Obviously, there's no methodology to go with that data.
Never has been.
And so this idea of data dependence is sort of a farce. That being said, how do they keep up how do they keep playing the game if the data's not there? What do they do? I mean, it's not shocking to me at all that they're split, right?
Yeah.
Why wouldn't they be? Nobody knows what's going on. There is no.
Well, if we are going to transition, and we're going to talk about,
we fully transitioned.
yeah,
We're out.
if we're gonna. Okay, so I mean, if we're discussing the Fed minutes, which is the only information we're operating off of right now, obviously, Jay Powell didn't say anything today. His speech this morning was pre-recorded. No information really on the economy, just small banking and stuff like that. So no impact from that, no knowledge from that. We have other Fed speakers that are, divided in the speeches that they have had. And we have FOMC minutes, which actually don't tell us anything. And I really dislike strongly that the market is making a perceived assumption of Fed policy off of those minutes. And that assumption right now, the big headline post FOMC minutes was, Fed split. And sure, the minutes point to that, but those minutes came before the shutdown. And they don't discuss the shutdown. They don't discuss the potential of the shutdown or how the Fed is going to react in the event of a shutdown. And I think we're going to see those opinions change a bit when it gets time for the meeting later this month. And remember, that meeting is later this month, so if this shutdown continues, like I said before, that spread and what we know and what could be is just going to keep widening.
Well, I mean, let's say we get to that meeting, and they lower the rate by a quarter point. Wouldn't that kind of just expose their bare ass to everybody?
I think actually lowering the rate with, I think look at it this way: before the shutdown, they were already split. It's like almost 50-50 right down the middle, and most of them see upside risk to inflation. So the majority seeing upside risk to inflation, about 50-50 on the upside risk to employment. So that means, to me, that looks like, from a policy stance, inflation's center stage right now. I think they feel that the quarter point cut was only permissible due to that weakness that we saw in labor data. And I think the likelihood of an additional cut with no knowledge of where labor data is now, probably a lower probability, and the upside risk to inflation just now greater. So there is a chance that the prolonged government shutdown could be perceived as having a disinflationary effect. But I think it would have to be far more than, a couple of weeks. It would probably have to be a month or the better part of a quarter before we really saw an impact from, federal employees just not, spending anything. And so, yeah, I think the upside risk to inflation is going to take center stage. I think that's going to handicap. Yeah, I think it's going to push the hawkish members of the Fed towards no cut, no change. And I think it's likely to push some of the dovish members onto that side as well. I'm sure if there isn't a cut, Moran's gonna, complain or, dissent. But outside of his extremely dovish take, I really don't see any of the other Fed presidents leaning that way. And so far, they've seemed to be, out, at least as far as their decisions go, uninfluenced by, any political strong arming that's gone on. I think like a lot of them are very confident in having Jay Powell in charge for the time that he remains. And so, and they've all been there long enough to be comfortable making decisions that, are going to be politically unfavorable. And so, yeah, I mean, I think no cut.
Yeah, I mean, it would be really hard. Obviously, I mean, I just know that the press would be all over him. Like you said, you're data dependent. You got no data.
Well, not only that, I think even if everything's going the exact way they expect, and the labor market's softening at a decent pace, it doesn't hurt to wait to December to cut. So they can just do a double cut in December, or December could be their last cut of the year. Like, I mean, when you're dealing with, an agency that's largely just rolling over 20 and 30-year debt, one quarter is just not a big deal, and 1 month definitely isn't.
Yeah,
So
I agree with that.
I don't think the pressure is all that high. I think the reason we hear so much about it is because on the speculative side, the pressure is very high, right? Everyone's priced in all these rate cuts, and they've priced them in at, like 100% certainty these cuts are going to happen, and those people are the ones that are probably in the position where they're worried the most.
Yeah, I could see
Yeah.
that. I mean, I think it depends though. Like, no cut versus cut. I feel like, yeah, if this shutdown lasts for, until FOMC and they don't get any data whatsoever, probably not going to be a cut. But I'm guessing that the data that does come in is going to continue to show, softening in the labor market. And ironically enough, I think that there's going to be some like downward pressure on inflation. So with that, they would be more incentivized to cut. But if they just don't get that data until it's too late, they're not going to cut. And then, yeah, you're right. They'll cut the next meeting if that data does come in, when it does come in.
I think I want to make one other point also, and I know I kind of harp on this one a lot, and I might sound a bit like a broken record, but I still think that the administration has repeatedly pushed to obfuscate market data and economic data. I think they've put quite a lot of effort into ensuring the data coming from the BLS specifically was either had someone in charge that was willing to change those numbers, or had a delay or whatever they could do. And I think a decent part of the shutdown, at least on the Republican side, benefits that goal.
But to what end?
Well, that's the thing, is how do you spin this? What's the narrative behind we don't have any data, so the economy is great?
So I mean,
they're going to keep it shut down till 2026.
I don't want this to get too political, but obviously, per Fox News, Trump's popularity ratings have fallen, and they are at record lows compared to other presidential cycles, even beating his own lows from his prior term. And Fox is, they're very good at doing polling. I think academically everyone would say that their polls are very, very conclusive. And given that, the one thing that those people taking those polls seem to be standing on is that the economy is strong. A lot of people don't like the militarization. They don't like the tariffs. They don't like foreign policy. They're not particularly happy about any of the like redistricting going on. I think for the most part, largely Americans are fairly center line, and so anything that's too far right, too far left, we get some pushback. And if you're thinking about how do you proceed with doing what you need to do when you're in office, you obviously need the backing of your base, and if your entire base is still the only thing you really have still going for you is the economy, then you need to make sure that looks great. And I think the attacks on the Fed and the push to spur QE and get rates down and get credit moving, and all of the attacks on the BLS and firing the head of director of the BLS literally because the data that came out was not positive. I think all of these things kind of point towards a government that is very focused on trying to ensure that the economic data being produced and being shown to people is positive, and it's showing job growth, job creation, productivity, and profits. And I don't think we have any of those things right now, and definitely not in the numbers that would be an improvement from the economy 2 years ago or 1 year ago. And so I think there's a big benefit to keeping this all shut down. Everyone's blaming the other side, and the Democrats have their agenda, and that's mostly focused on healthcare. But I think if you really need to obfuscate the data a little longer to do what you need to do, this is the way to do it.
Well, the entire focus is on healthcare, right? And that's the part that I think lends credence to your idea that a lot of this is for optics. I mean, the healthcare thing, like all of a sudden it's becoming such a huge issue that we're willing to shut the government down over it, right? Where it wasn't such a huge issue just, every single fucking year, right? Like, I mean, yeah, like I don't think that you're wrong. I just don't see how whatever truth comes out, right? Like that's going to be the interesting part. And honestly, the longer the shutdown goes, I mean, when you think about government workers, they're a fairly even split. I mean, sure, they're more Democrat favored in federal jobs, but the next payday is tomorrow, and it's looking like they're not going to get that check, right?
Yep.
And so usually there's these banks that will do these interest-free loans and say, here, you can have this money and you can pay it back when you get your back pay, right? But the big question mark comes in: are they trying to actually not pay federal employees at all, which Trump brought up? So that's going to be interesting as well, because if they end up not doing back pay for these guys, that's going to be a huge negative impact for the economy, like in the short term, just a big impulse to the downside in terms of just spending, right? Like it's going to be gnarly.
So it'd also be a violation. I mean, there'd be lawsuits. It would be.
That's not important. Yeah. Okay. So you mentioned that the healthcare issue is what's on the table, but I think all of this is centered around obviously raising the debt ceiling, and we can hem and haw about what to cut or what not to cut. But the issue is that we're spending a lot of money. Right. And we could talk politically about how useful the debt ceiling is and all of that. But at the end of the day, we're spending a lot more money than we're bringing in. And that is clearly causing a lot of speculation against the dollar as well, I think. So I'd like to pivot back over to gold. We talked a little bit about that last week, and obviously somebody's buying up lots of gold. People are buying up really everything that's not the dollar, although the dollar's kind of the least shitty of the shitty fiats right now. At least it's kind of got that going for it.
I just want to point out that me and Girk sort of discussed this. We've been discussing this for a while now. And, when you talk to people about things like, currency risk and all that in the dollar, they tell you you're an idiot. And I think that what we're seeing is that maybe Girk and I aren't actually idiots, right? Like it's what you're seeing in gold is this just gigantic explosion in demand ever since like the end of August, and it has not really let up whatsoever. And I think that is definitely a result of central banks, especially just wringing their hands and wondering what's going to come of U.S. fiscal policy.
Yeah. Not only U.S. fiscal policy, but U.S. monetary policy has a big effect there too. I think.
But I think the fiscal side is I think the fiscal side's in the driver's seat right now. They just shut down the government. So like,
well, yeah, no, it absolutely is. And the most recent reaction in gold is definitely that. But we also see a Fed that's no longer targeting a 2% long run rate. You know, we're looking at the last summary of opinions pointing at 3%, which we've been saying since
are we as a society ready to
2022.
accept that?
Well, I mean, it doesn't matter. It's there, right? That's what they're telling us. They're telling us, you know, inflation was transitory, but now 3 years out, we're looking at federal funds rates at 3%. And I wouldn't be surprised if by the time we got there, they were maybe higher or substantially higher, depending on how we manage the fiscal side. And so far, we're not doing that responsibly. We do have some of this money coming in from tariffs, but those tariffs are starting to have, you know, negative foreign impacts because obviously they drive down U.S. demand, and so, you know, over time they're eroding the global, they're eroding the demand in the global market from the largest consumer, which is us.
This is something interesting that just occurred to me. You know, it's been communicated by the farmers recently that they're having a lot of trouble, especially like soybeans and other crops. Their silos are full, and it's become a political issue. And I believe the last I heard the Trump administration talking about it, they were discussing some sort of stimulus package or bailout package for them of some kind. I don't know most of the details, but would a shutdown make this kind of deal making difficult to do, and could that put a lot of pressure on them? Because I mean,
No,
I don't know how
because,
long soybeans can sit in a silo, but
well, I mean, there's issues there. I don't think any stimulus is going to be to like buy the soybeans. I think what we're dealing with is, you know, obviously the tariffs against China have caused China to react, and they're not buying U.S. soybeans, and they are the number one buyer of U.S. soy. U.S. makes a ton of soybeans. We grow shitloads of it, and now we have no one to sell it to. Yeah, Western countries use it, but they don't use nearly as much, and so that puts us in a position where, yeah, like you said, all these farmers are sitting on all this soy. Argentina, who we're also apparently bailing out, is now selling China their soy,
doing some sort of currency swap. Yeah,
doing great on that. And so, yeah, I mean, it's a very disadvantageous for American farmers, but I don't think the shutdown is going to prevent any type of aid in that regard. Obviously, as long as the money gets congressional approval, they can pay out any kind of stimulus or bailout package that they need to in order to right that situation. But that's just more money. Yeah, it's more money that we shouldn't be spending on something that we never needed to spend it on in the first place. And then how much is it going to cost us to pull off this bailout compared to what we're making in revenues from tariffs? You know, tariffs are globally, I think the IMF said the other day, at about a 17.5% feedback, but global demand, import demand, is way down year over year. It's been, I don't know the exact figure right now, but it's a massive drop on import demand. And so, you know, is that going to continue? I know inventories are running low. We're getting into the part of the business cycle where we're going to have to start buying into those tariffs. But I think that's just going to be a driver of more inflation than anything else. And I think companies are going to be very selective about what they buy from overseas, especially from countries where the rates are substantially higher, like China.
Yeah. Well, you know, I had one other thing I want to talk about, but we also got to keep this moving. So maybe I'll pin a discussion on our favorite special coin in relation to, you know, running from the dollar for a later time, or maybe we can get to it at the end if we have time there, but I doubt it, the way we like to drone on. All right, so let's move over. Anything interesting happening in earnings this week? It seems like kind of a dry week.
It is.
Delta did okay.
Yeah,
Delta Airlines, they're okay. Yeah,
which was a bit of a surprise. So maybe domestic travel up. I know corporate. International. Yeah, I know international travel has been suffering quite a bit, and the tourism and services industries have not been doing that well. But Delta's kind of surprise on their earnings, and yeah, I mean that may show just more corporate travel going on in the last quarter, because we know for a summer, or at least summertime, tourism travel is definitely still suppressed. So
Yeah.
um
But there's a lot of trade shows in the summertime. So, like, that's kind of, I think, where a lot of that came from. Trade shows, conventions, that
yeah,
sort of thing.
Delta's also a favorite. I would want to see the other airlines, because I mean a lot of corporations have cards or deals with Delta.
Hmm.
They're definitely, them and American are like the two big corporate providers. So I would want to see some other airlines and see how they're faring. But it could be a good sign. I mean, at least business is getting done.
Right.
Yeah, well, it looks like too. I haven't dug in too far into it, but it looks like PepsiCo also beat expectations as well on strong international growth. So
Yeah,
at least
yeah,
the little
no,
bit of data that we have from notable earnings aren't terrible. Not yet, anyway. I don't know what the actual expectation was. I don't know if
I do
they.
want to point out, along with earnings, we are now deep into the corporate blackout period. So share buybacks, which have not been very strong this quarter, obviously because of PE ratios being so high, share buybacks are basically blacked out for like 80 something percent of the S&P at this point, until we get to bank earnings, which I think is 2 weeks out, or next Friday is maybe bank earnings coming up. I can't remember off the top of my head, but we're a couple of weeks out at this point. And then that's when they'll start back. But the big share buybacks, the bigger components of the S&P, those are going to be a little bit more than 2 weeks out, and those represent a substantial amount of the flow into the S&P 500. So the market is bereft of that right now, and I think that might be one of the reasons we're seeing the market behave in such a choppy fashion. Like, we keep pushing like a little higher and then dropping, and pushing a little higher and dropping, because we don't have any buybacks to kind of continue to come in and stimulate that pump to the upside. Especially after the $1 trillion in AI circle jerk that went on over the last week between OpenAI and NVIDIA and AMD and Oracle.
Yeah, that was wild. All right, so government shutdown. What data are we actually getting next week? Well,
I don't think any of
tomorrow
it.
and next week. There's got to be something.
Next week,
Some like private, like ISN. I don't know. There's got to be something.
Next week. I mean, we always have international data. I think we get NFIB, so the optimism index. All the data that comes out of the Fed is going to continue. Like, we got
Michigan
consumer
tomorrow?
credit this week, which was way down. Revolving consumer credit was down like 15 billion. We get Michigan on Friday, tomorrow. And then we're very likely not going to get CPI, which is important, but
Oh,
or
that's
PPI.
next Wednesday. Oh,
Yep.
God.
And I think that's probably the point at which the fear about the shutdown really kicks in on the financial side. But I think we also won't get housing data. And that's a very big market that is extremely reliant on that data for pricing. The MBS and CMBS markets use that permit and home sales and price data to value MBS. And as it gets harder and harder to maintain, appropriate value on those securities, that's going to get pretty scary, given that they are such a huge component of total debt owned by large banking institutions. So,
Well, I mean, it's also, they really need that localized data too. I mean, like, without the local data, like, you run into this issue where you don't know how correlated all your fucking MBS are, and that's dangerous. And so you'll see risk get priced up pretty quickly. If the less hints of inflation data we can get, and the less localized data we can get, the more fucky and risky things are going to start getting priced, just by nature of not knowing anything about the likelihood of default in a lot of your credit.
Yeah, Dork, did you apply for our ISDA yet, so we can go long some credit default swaps?
I mean, I don't know if we're in that territory yet, but I mean, we've kind of been really tiptoeing around it for a while now. So it's the thing that I think about though with this shutdown. I think that the banks are more concerned about is that they can't quant their way to success as easily without it, and so they're going to start pricing in more risk and probably start deleveraging a little bit of
they're
it.
going to start to lower their margin ratios, which are
Yeah,
sky
exactly.
high. We're in a market with, so much leverage right now, and as all these spreads between what we do know and what we don't know widen, that risk tolerance is going to start to dry up, and as that risk tolerance starts to dry up, those banks are going to start pulling back on that margin that they have extended, and it's quite a lot of it.
I want to bring up another thing too, because you guys got to have your own conspiracy theory, so I get to have mine. In terms of, you mentioned that the consumer credit didn't look great. There's actually been a number of revisions to commercial bank loans that has been occurring since the beginning of January. I was kind of digging into this, and now I am not a bank expert. I have been talking to them on Twitter, and they all assure me that it's a nothing burger fine, and there's lots of good reasons for
Have they
why.
used the word non-material yet?
I don't know. I
That's
didn't
when
know.
They're really fucked.
Half of it was word salad, but the stuff I did understand was basically. So let me tell you what happened. So basically, banks. You could go to a bank and you can get a loan, right? As a consumer, you can get a loan for a car, you can get a loan for whatever, right?
Uh-huh.
Or you could also, if you're buying a car, for example, you could go to, the car dealership, the used car lot, and they can give you a loan, right? Which they go to the bank and say, hey, I need a loan. It's collateralized by this car. Then they get the loan from the bank, and then they give you your loan, right? And so what the banks were doing before the beginning of this year was they were saying, okay, that's an auto loan to a consumer. And they were marking that as an auto loan to a consumer. But that wasn't the bank making a loan to a consumer, right? That was some secondary person who's claiming, some private company who's claiming that this is the collateral on this debt, and that they're not double dipping on collateral and things like that, right? So you're placing a lot of trust of the risk management onto these private companies and taking them away from the banks, right? And everybody thinks if you're a commercial bank and you're giving all these loans out that you're going to be, you're looking at the default rates and stuff like that, and you're saying, okay, credits, loans are going up, default rates are staying steady, everything's going great. But what the Fed then was worried about was, they're concerned about, the lack of transparency by the fact that basically all of these loans are getting fed through, a private enterprise, to go to these various places. They said, okay, now you have to take all these loans and you have to actually just call them, a loan to a non-bank financial institution, right?
Uh-huh.
And so that's what occurred. And you could go on Fred, and when I started digging into it, it's because I was just dicking around on Fred, looking at bank loan stuff, and I saw all these spikes and jumps, right? Like NFBI loans like rocketed up, and then consumer loans went down something like 100 billion, which is like 5-6% of all consumer loans by banks went down. And then C&I went way down. And so what this signals to people is saying that, hey, what we thought was like really good organic growth coming from the banks is, I think one of the big important things is that, the bank's not tracking like the delinquency on the loan from the private equity, right? They might be having some delinquent payments, but they're still making the payments on their loans to the bank, right? And so you're having trouble getting transparency on what's the distress level going on in these loans, because from your perspective, it's being paid. And so if you let's say worst case, if you take all of the consumer loans that went from that was taken out of the bank's bucket and basically put into private equity's bucket, and you assume that all of those are delinquent, obviously that's an insane assumption. But if you assume all of those are delinquent, I mean, that puts our delinquency rate at like 10%. It's above 2008 by like double. It's crazy. And so it's probably crazy to say something like that, but at the current rate of 275, it's probably likely, especially with those big people like Tricolor. We talked about that a while ago, and some of these other private equity places showing strain. And if you look at some of the bank people that I talked to, they were telling me to look at private equity stocks. People are looking at those now. Those are really struggling, which are showing signs that the delinquency is more elevated in those private equity accounts. And so I think we can basically take all the delinquencies that we're getting from public banks and add something to it. I don't know what it is, but add something to it. And everybody else is sniffing around on this too. And so everybody's starting to get a little bit worried that they've been underpricing risk because of some of this. I just wanted to bring that up because I think it's notable, especially as you said that, credit doesn't look great on the consumer side. How much of that credit that we thought was coming from banks is just coming from a firm, which is giving out like the worst of the worst types of loans that, who knows, right? Somebody probably knows, but I don't know. And it's not something I can get the data on, but it's something worth noting that I think there are more cracks showing up than I think we realized in the past because of this lack of transparency and reporting, which has now just gotten worse, right? Because the government shut down. So
yeah,
it'll be interesting to see.
Well, I actually kind of want to. We don't have too much more to talk about, and I feel like touching on this thing that you're bringing up is pretty important. If you look at if you just look recently in the last 4 years, we've had 4 fairly major shocks due to like NBFIs or non-bank financial institutional leverage, and that kind of circular risk that exists with the GSIBs that support these institutions. And in 2020 we saw the kind of pandemic era liquidity scramble, which was big enough at the time, I think, to really highlight the amount of stress in the system, where we MMFs broke the buck again, and it impaired market function for a little while until we got some central bank intervention, which happened fortunately very quickly. The Fed was in a great position to step in and help out with that. And that led to the SEC and European banking commissions and Basel reforms, and we agreed to do all these things. That we're not gonna let that happen again, just like 2008, and since then we've kind of let all of those demands on our banks and the banks in that system erode. In the pursuit of supporting those banks due to their hold to maturity losses, we have pulled back regulation after regulation that was supposed to be imposed, and we've really like kind of put ourselves now back in the same position that we were then. Not only that, we're doing like a lot of buyback from on the treasury side, and we keep pushing Basel endgame off more and more. Like, we're just not ready to do that. And I think and then we saw that lead to what it was like Archegos, and we saw that lead to the gilt shock with the UK pensions, and then even in 2024, which everyone thinks of as like it was a free and clear year. I think people forget like the yen carry momentarily collapsed. And there's that FX market, derivative market risk that's also being carried. And I think structurally, all of these things are still very unsound. And I want to kind of bring people's attention back to, remember all the CMBS risk?
Yeah.
And everyone was just talking about, oh man, these CMBSs are going to fuck everything up. Well, defaults on those are now at all-time highs. And we haven't heard a peep out of any GSIB at any earnings call about what they're doing to manage the stress of these rapidly defaulting CMBS tranches. And the only thing I could actually think of, and actually until you started bringing it up on Twitter, I hadn't really thought back on it. The only thing I could really think of is they've been passing the buck or selling off these toxic assets or shifting these toxic assets over into the kind of like over into the non-bank financial institutions where they don't have the reporting requirements, which means that risk is still effectively sitting on their books, arguably sitting on their books with even more risk and more leverage. And I don't think anybody has addressed it at all.
Yeah, I've been told that that's small and knowable, and then I ask, how can I know that? How do I find that information? And I haven't really gotten an answer of, how much of that is them just passing it over an
Well, I mean,
existing bad
I
loan
guess the thing
over.
is so if these are tranches of like, CMBS just by themselves, I mean, I guess it comes down to sort of the relative risk of everything in the tranche, right? Like, because you have your stacks of default risks that they plop them into when they build these things. I mean, really, if they can distribute that risk creatively enough, it can take a very long time for the risk of those highest quality pieces of the tranche to actually show signs of weakness, right? So like when we think back to like 2008, the biggest issue with the whole CDO thing was that your CDOs would have these like very bottom tranches that just sucked, right? They were piece of shit stuff. And then at the top, you had your best tranches ever. They're the greatest things that never going to default. And the whole idea was that there was a spread between those in terms of their yield. So you can buy pieces of it and whatever. But the whole idea was that the default risk was the highest at the lowest tranche, and then it's the lowest at the highest tranche. And they're specifically not correlated, right? Like those risks are like the whole idea is that the correlation between them is low so that you can say that this is a diversified asset and it has low risk overall. The problem in 2008 was when the default risk was shown to be high in pretty much all level of those tranches, all of a sudden something that you were, holding that had like a 15 basis point spread or something, it goes up to like 3%, right? Like, and so, the value of those tranches just immediately goes to zero, basically. And that was what happened in 2008. Like, so I think by now we've probably gotten more creative with how we actually distribute that risk. I
Well,
have to believe so.
well, we rolled, a significant number of the 2024 maturities forward to 2025, but 2025 maturities are now 957 billion about across all CRE lenders. And banks are holding about 50% of that in CMBS alone. And I think 151 billion of it's scheduled to mature in 2025. And so if we're talking about risk mitigation into NFBI channels, right? Part of what once would have shown up in CMBS is now probably living in like CRE CLOs with MREITs or like with private insurers, right? And so
Right.
if we're thinking about like CMBS plus CRE CLO issuance, I think year to date we're at about 84.1 billion. And CRE CLO 30-day delinquencies are around 5.5% right now. And that denominator is being pushed up by the amount of issuance. So if US insurers are holding 823 I might be off by a digit billion of CRE mortgage loans on their balance sheets, and MREITs are managing the book value hits and the dividend cuts on that legacy exposure, That's how they're probably diffusing the stress in those tranches. Which also which also means if those tranches start failing, everything's gonna blow up.
Yeah, I was gonna say this is worse
in a really, really bad, like multi-trillion-dollar way. And so I don't know. I feel like keeping an eye on like distress minus delinquency or CRE CLO delinquency over the next few months, 6 months or so, very important, because
whenever the data shows up.
That sounds like too large of a contagion for either the federal government to handle or the Fed.
Oh yeah, that's massive if that's the case. If that's really what's
And
going
what
on.
you're pointing at, JFresh, is kind of the exact methodology that they would want to use to hide that risk.
Yeah.
Or at least
but there's also
right?
plausible explanations to say that they're not, right? So where I kind of ended up was we don't know, but it's likely worse than we think it is.
Yeah, it's interesting to say the least.
So like for example, I'm looking at Blackstone stock down 7-8% over the last month. Other places show similar things, right? And so I think that might be the place where some of this starts showing up sooner before you start seeing it on official numbers for just signs of distress. But another interesting thing to point out is you think about the AI build out. Everybody's talking about building all these goddamn data centers, and then you look at the consumer and industrial loans from banks flat.
Okay,
Nothing.
so as soon as those loans start coming in, that's when we need to get the eyes to and start purchasing CDS on Magnificent 7 loans to private companies. If we can do
this
that.
is all private equity funded. There's nothing for banks. Nothing.
Yeah.
Zero.
Okay, so even better. So we just, fucking Blackstone, I'm sure, is at the helm of all this crap.
I don't think there's anywhere to share this report, but yeah, back in June, FSB released a warning that concluded that commercial real estate had so far weathered the recent adverse developments. And it attributed this benign outcome to the fact that downturn has only hit parts of the markets, and some distressed borrowers have refinanced and leverage levels are lower than in prior crises. But it warned that in non-performing loans and commercial real estate lending for office buildings by U.S. and Australian banks had been increasing significantly in 2023. Interest rates for commercial real estate-backed mortgage securities, which packaged up loans in the sector, had risen sharply compared to other corporate loans, FSB said. Distress was evident in multiple segments of the CMBS market, with office and retail segments having the highest rate, 12.6% and 11.2% respectively. Financial leverage among commercial bank real estate investors seems larger than at other kinds of non-bank entities, and the report found that estimating the aggregate debt in the sector globally was 45% of total assets. It warned there was a tail of real estate investment funds and other property funds in the US, Canada, Singapore, and Germany that have large levels of leverage and debt, with debt being at least 3 times equity. Banks still have the most exposure to commercial real estate, worth about $8.5 trillion globally, the report said. And it said that banks had complex interlinkages with non-bank commercial private property investors,
Jesus
raising
Christ.
the risk of property shocks spilling over to the banking system. It said that there's still considerable data gaps on the links between banks and such non-bank investors in commercial property, and called on regulators to close such gaps. Okay, now this goes back to me saying that the government really doesn't want anybody to find out how bad the economy is doing, because the first thing that will happen is what?
Correlations are going to go up.
Correlations are going to go up. Rates are going to rise at the top end, which means that CMBS loans and refinancing on CMBS will halt. CMBS lending will lock up, and property values will then decline. Which then
that's gnarly. Oh God!
I
So
love
they just straight
Edge
up said
Rush.
it. They're like, "Oh yeah, we can explain a lot of this away." Then Gert comes in here, and it's just like, actually,
And then you've got such great institutions like, I'm sorry, Ron, I know you want me to move on, but I'm going to throw this one more thing in there, and we're going to go a little long, and you're going to just like it. Then we have such great institutions like Tether, who's now mulling around issuing a $20 billion equity raise.
Do you want me to
For
get
things
started
and
on how
let's
we're
see,
gonna package up our debt into stable coins and then slowly devalue them? Because that's a whole nother conspiracy I don't think we have time for today.
yeah.
and by the way,
and,
Ron is
well,
our dickhead producer. So when we yell at Ron, we're yelling at our dickhead producer who tells us to do
Yeah.
things we don't want to do.
yeah.
He stabs us with
I
sticks
just
if
wanna
we don't
say-
listen to him.
I
It's
just
true.
want to say really quick, fuck you, Ron.
Asshat.
Anyway, okay. So hold on. Tether has said that they are they were potentially going to use the funds to maximize the scale, quote, of Tether's strategy across existing and new businesses by several orders of magnitude. And he added that the CEO added that those business lines include stable coins. So a stable coin company is going to invest in other stable coins. It doesn't make any sense. Why would you do that? Distribution ubiquity. Nobody knows what that is. Artificial intelligence, because why not? Everybody else in crypto is
That's
buying.
the one that makes it worth $20 billion.
Yeah. Commodity trading. That sounds like a good thing to be doing with stablecoin funds. Energy. Nobody knows what that. I mean, that's massive.
That's just Bitcoin mining operations. I'm sure.
I mean,
and communications and media. That's not even is that a business? Are they just going to spend money on ads on?
Yeah, they're going to get Super Bowl ads.
Waifu?
That's what they're doing. They're raising money for Super Bowl ads.
Are we going to get the Tether Super Bowl ad?
Yes.
yeah, I mean,
Fortune favors the bold.
Now we've got a government sitting on $37 trillion of debt, right? And so if you can money market fundify these stable coins via the passage of, I don't know, maybe a bill that's currently on the congressional floor that does exactly that.
Oh my God, I hate
and
that bill.
you can approved stable coins have to hold 100% of their reserves in public debt, right? Then you basically created an anti-Fed by creating a group of prime dealers forced to buy U.S. Treasury debt regardless of market condition. Okay. And then what you can do is you can change the economics of not even like, well, you can force a conversion to a central bank digital currency. Okay.
Okay.
And
Now we've rounded out the conspiracy theories.
And then you can
change
you can slowly dial the economics of that conversion to ensure that the redemption window occurs in a way where the conversion to the CBDC is at like 98 to 1. And then if you can pull that off, you're basically slowly devaluing your debt via these stable coin forced purchases while blocking the Fed out. So
yeah, that's because I mean, my initial response to that would have just been, well, I mean, in terms of like buying the debt, you're just basically moving money from money market funds and other things to a stable coin. It's 6 one way, half a dozen the other, right? You're not getting more money; it's just being piped through a different route. But I didn't think about that power dynamic of moving things around. That's interesting. Anyway,
yeah.
okay.
So when
I
Russia
think,
says Trump's trying to convert all of our debt over to stable coins and then devalue it, they're not lying.
yeah, he did say that. Unfortunately, nobody in America cares what he thinks and thinks that he is lying. But yeah, I mean, he clearly sees that as a risk, right? Which you know, think what you will of him, he's survived this long.
Yeah, I mean, you hold 100% of U.S. public debt, and then you force settlement redemptions at NAV. Treasury only issues like in the 2 to 5 year window. That's the qualifying bucket, and then yields jump, NAV falls. redemptions cleared a peg below the dollar, and you just walked away with a significant amount of debt clearance.
Man, I wonder who's
I
going
don't
to be
even know how
holding
to
the bag
respond
for
to that,
that.
so I'm just going to transition. Let's go to audience questions, Stork.
Yeah, let's do it.
Yeah.
We got a few. So I'm gonna grab. We've got a few. I mean, I kind of want to stay on topic here. And by the way, for the audience, there's a link in the description where you can go to submit your questions. Ask us whatever you want. If it's a good question, we will definitely get to it because we love good questions.
And if we don't read
have
it, it's
time.
because it was a shit question. You
Yeah,
can
or
try
we
again, though.
definitely not that we ran out of time. Yeah, but if
But
we
you can
see
keep
some, we
trying
can.
and we
Yeah,
might get to it.
yeah, we'll probably earmark some of the best ones to make sure we answer them. But I think this one's good. Could you explain some of what we see as far as expected trends or market conditions typically seen in Q4? So, like, okay, how are we looking? What's the Farmer's Almanac say for
Seasonality?
Q4?
Seasonality? We want to talk about that?
I don't know.
Nope.
I mean, we're just heading into a fresh new
Seasonality
quarter.
has no statistical
The variance
relevance.
is larger than the mean. That's all
Yeah.
I'm going to
Well, I
say about
mean-
the seasonality.
Well, so this is less to do with seasonality, more to do with we're heading into holiday season. Of all the seasonalities, holiday season is one of those things that is the most predictable thing in America because everybody loves to, express their love for each other with rampant consumerism. So everyone, I just expect it.
Hey, you need to be respectful of my religion,
Are you a
Dork.
communist?
I love rampant
and
consumerism.
Alcohol.
Thanks for that, Ron.
Alcohol's well, it's almost like a commodity.
Yeah, it is.
So okay, so I'll put something out to you. I'll ask you guys another question related to this question. I've talked to some money managers, and they've made the statement that a lot of other money managers are, compared to the market, right? They basically, you said we've talked about before how everybody except for retail kind of missed that pump after April. And so now you've got all these money managers who are underperforming and they're looking to make their year. I have heard that some of them are looking to make it through AI because why not? Everybody else is, and it's been working so far. Could that be enough to float or sustain or even continue to push up the AI trade into the end of the year?
Potentially. I mean, I think we have some obviously macro headwinds to realize that goal, but maybe the way they make their money is just no Santa rally, right? I tend to find that you get a lot of years of the market expecting one thing, and oh man, we had seasonality was bullish in a quarter where it's historically not, and volatility didn't rise as expected, and but at the same time, we're looking at positioning data, we're looking at where these people are actually putting their money on the table, and I'm not seeing these like rallies to 7,000 or 7,200 or these absurd rallies that these analysts are calling for. And given that funds, hedge funds, CTAs, banks, we're all like institutional investors, we're all largely short this entire rally. And most of the last leg of the rally has been them short covering. Might just go short again, I mean, why not? Retail's scared now, we're seeing a lot of news about how everything's a bubble, and the only people that ever gets any news printed in Bloomberg are financial managers, and so I would assume that they're trying to shake the tree a little bit because you don't want to buy assets here. I mean, I posted a chart on Twitter this week, which in my rare postings on Twitter, I do try to post things that I think are at least slightly meaningful. And I posted a chart of, it's a statistical chart of 5-year returns. With the market at various levels of price to earnings ratios, and the 5-year returns on the current PE ratio of the S&P, which is about 22.3%, is 0. And so, if you're a fund manager and you're looking at that chart, and going long things now means 0 return over the next 5 years, are you going to go long? I don't think so.
Yeah.
I don't
I
think
mean,
so.
that's
And
very true.
I think
But people have been
CTAs.
saying that for the last like 20% of the S&P rise, right?
Yeah,
Well,
no, but
10%.
now we've actually had a statistical correlation. When
Yeah.
there were returns to be had when we were at 20x PE. There were returns to be had at 19 and 18x, and we're just so far above that. I mean, the market has returned almost 40% since April, since April's low, and there's not much juice to squeeze. But there's still a lot of people willing to buy that AI trade, and sometimes you need liquidity for the downside too. So, I mean, I'm not saying that's going to happen. I think the more realistic outcome is probably we chop, maybe gain some incremental, and I mean really incremental upside into the end of this year, or it all tanks. And the institutions get rich while retail holds the bag, which seems to be tradition for all major market corrections.
Does seem to happen. Yeah, I mean, so I just want to add, everybody's always looking for, and I get in fights all the time on Twitter for some reason because I have a mental illness, but everybody's looking for a correlation that they can use to predict the future, right? Look at how many times this happened in the past when this happened in the past. Therefore, if it's happening now, I should expect that it will happen again. And even if that was statistically valuable, which it's not, usually people are noting like 5 times in the past out of, 100, it's hundreds of events. It's not relevant. It's noise. But they have picked out something that is notable in the past, but is not really sustained in any way. You have to kind of let that go, because even if that was true now, I'm sorry, even if that was true in the past, because so much has changed now. I mean, everything from COVID on has pretty much kind of thrown off every long-term correlation that people had, and that's been a lot of what's going on, just over the last few years with the booms and busts and things, and everybody's mispriced things. I mean, just look at like insurance. Insurance is rocketing on everything. I know, because I have my beautiful 2.85% mortgage, but my payments are going up because my insurance is just going rocketing, right?
I knew he was going to bring it up.
Okay, he loves his mortgage.
I mean, how many people can say they own a mausoleum?
40%.
I'm going to die in this house. But yeah, so you have to look at other things and say, okay, it's different. I can't rely on correlations. You have to try to smell out what are the positions in the market and what are the motivations of the people in the market. And, like Kirk was saying, there are signs that so one of the biggest indicators of whether the market's going to go up or not is if the amount of money going into options is going up or not, right? And that's true. We're currently sitting at the highest contract values for the options market in the history of the market. We surpassed the last high, which was OPEX in September. Preceded by that was November of last year, right? And so it started rocketing right at the beginning of September. It just started going straight up. But one thing that I will note is that although we have hit fresh highs in contract value, the total delta on the market, or the total leverage that people have, is lower, right? So we're well below the peak from September OPEX, and we're still a little higher than last November, but it's basically, it seems to be losing some steam. So what's happening is that people are buying more contracts, but they're buying them farther out of the money. Who does that sound like? Retail.
Yeah.
Interesting.
Or
at least that's
very bearish institutions.
that's my thinking of it, right? And so you have this very strange situation where people are putting in more money but taking on less leverage, right? And the last time that happened was kind of started like in December of last year. So if you look, like, yes, we had this big crash in April, but like that trend actually started after that December OPEX, where leverage on sold puts basically just started falling off, and then eventually it got to it had a just a spark, right? Because stocks are still going up, even though this was falling off, and then you had that spark, and it just kind of cascaded out of control. That's happening a little bit again now, right? So we peaked in October, early September, and it's been kind of falling. So people are wanting to sell fewer way out of the money puts, right? And then call leverage has just fallen off a cliff, which means nobody really wants to
By the upside.
buy the upside.
I thought
So,
another
I
really
mean,
interesting thing was that SPX options are now 74% of the total market share as of the beginning of this quarter, as of September 30th. They represent 74% of the market share, with E-mini representing 11 and SPY representing 15. And that's a lot of options. It's the highest ever on record for the SPX. And if you look back at quarter 2 of 2020, that was 58%, and that was the recovery from a crash. We're 16% over that now.
yeah, I mean, if you look at single names too, I mean, the only thing that really stands out, obviously, besides like SPY and QQQ, which don't really count, like Nvidia, Tesla, and then followed by those two who are always usually pretty high, gold, IWM, right? Those,
Yeah.
and then you've got like Apple, Meta, Microsoft, and then now AMD is pumped up, but everybody else, it like peters off, and
That's
it's
a
really
change.
tight.
I want to point out that that's a change from a little over $500 billion in derivative leverage on the S&P 500 to $3.3 trillion in derivative leverage on the S&P 500.
Yeah, no, it's massive, and
Yeah.
it's
If the percentages
it's
didn't sound big enough, I wanted to. That's a lot of money.
yeah, I mean, so like you said, from the 2020 crash, I mean, right about then there was like $2 trillion of delta on the market, and now it's 6. So in 5 years, it has tripled. If you want to know where all the price improvement has come from, of course,
Yeah.
I'm biased, which is why I got in this game and started tracking all this stuff. But
I mean, that's why we've made GammaStrike.
Yeah.
So we could have a better way to see all this data, because
dang it, Dork, the answer to this question, just get a subscription to GammaStrike.
I mean, you could find out a lot about, forward sentiment from GammaStrike actually for Q4. I mean, it's all the options data is all there, so you can kind of see it. But
we know we don't know how people are going to change their mind, but we know exactly how they're positioned right now.
Yeah, we know their mind in this moment.
All right, I want to get this over with. Now that we've gotten all our conspiracy theories out, we're probably canceled anyway.
Always.
So let's go to any updates.
We actually did have a pretty cool update. This is nerdy. I know no one's going to appreciate the amount of work that went into it, but we've been, as everyone knows, who's been kind of following along, we've been working on getting the second version of our real-time data suite out. And we now have candlesticks. So we have multiple time series on the intraday trading, and those are weighted to DEX and GEX exposures and the put call ratios. And so, if you don't want to trade on the 1 minute, which a lot of people don't, we now have, the option to look at the 15, the 5, the 30 minute, the 1 hour, and that should help you if you're maybe a longer term trend follower, or you want to be able to see multiple days. And we also, I don't know if we mentioned this the last time, but we now have historic data on the live data as well. So no more of the.
I have to say, I
chart
fought you
opening.
on it, but it's pretty awesome.
Yeah. You can now see the overnight gap. You can see the prior day's price action. You can visualize your levels a little bit better day over day. And then, we also have the delta and gamma flips concurrent with that. And so you can kind of go back and look at the prior day's price action, make new assumptions and then follow those longer term trends while you're trading the intraday.
He's really been our wonderful back end guy has really been working on this for a month now. He has almost a month of data backfilled on the 1 minute candlestick.
Well, no, he's been working on this for multiple months, and that's just when he hit the switch on collection.
I'm saying the historical saving it, because we used to throw it out every day because it was such a massive amount of data. And then Girk was like, what if we stored it? What if we stored 30x of it? It's like, oh God. We were like, what, 5 days? They're like, no, 30.
Well, now we're doing it.
All those calculations.
It looks great.
Thanks, Nuke.
Yeah.
Shout out to Nuke.
Yeah, Nuke. Thank you.
Yeah, we need an animation for Nuke now. For when we talk about new features,
bets.
we just
what
play
are we betting on?
Oh yeah, that's right. Yeah, it is time for stupid bets.
Wait, you got to play us in.
Stupid bets. Stupid bets. Who's gonna win? Who's gonna lose?
Well, Dork got trounced in his prediction that the government shutdown would be like other government shutdowns.
You know what? You know why I did that, right? It was beautiful, isn't it? The fact that we were able to have another stupid bet.
Winning with a 0.1% chance, JFresh.
Yeah.
Feels like buying a 0.01 delta option and watching it print.
Good thing I didn't play the historical correlation guy who asked that question earlier.
Yeah, right. That'd be a historical correlation. That's what I played. Yeah, because I was like, why not? And it also made it so we could have a new stupid bet this week. Because, I think even if we did this yesterday, it would have been a foregone conclusion, or the day before, it would have been a foregone conclusion.
All right. So what do we bet this time? Got to be something good. I mean, government's still shut down.
Yeah, we can't bet on the government shutdown again, though. That's no fun.
I'll be in Chicago this weekend, which is unfortunate timing with the National Guard rolling into Chicago.
I want to bet that volatility picks up when we don't get our CPI report.
Ooh. Market reaction to CPI bets?
Market reaction to no CPI.
Right, yeah.
So we all have to agree. Okay, so nobody wants to bet on whether or not I get beat up by the National Guard. That's fine.
Are you at risk? I didn't realize you were a part of Antifa.
I don't really know why they're there, to be honest. I don't
hanging out.
I don't know.
Are they the Texas National Guard? Because I saw those guys getting off the truck, and those are some meaty boys. They've never
they've been enjoying their baby backs.
Actually, you know what? I'll just walk around. I'll just keep my Texas ID handy in my pocket and be like, I'm one of you.
You're a ginger. You're not at risk of getting deported.
Yeah.
Yeah, and if you don't put on a pastor outfit, you're not going to get pepper sprayed. Before.
That's normal, right? Just getting called names by random people.
I mean, yeah.
All right. So we all assume the shutdown is going to continue and we're not going to get CPI and we're going to make bets on what the market's going to do.
Yeah.
When
sounds like
CPI doesn't come out.
Yep.
Is this like a up or down at 7:30? Or sorry, 7:30 Central, 8:30 Eastern? Like up or down at the time it doesn't happen? Or
I think it'd be the night before. If the government hasn't reopened the day before the CPI print, that's when you would see the reaction.
I mean, you'll start
they're
seeing the
putting a
reaction
bill-
way sooner than
They're
that.
putting a bill
Wait a minute.
on the House floor every single day, right? So
You know what we got here, right? You know what we got here.
Mm.
Keynesian beauty contest.
Yeah.
Oh boy.
You love these.
I know everybody's going to want to try to get out the night before at the government shutdown. So I'm going to get out a little bit before that. But I
Yeah.
know that everybody else knows that I know. And they're going to try to get out a little bit before. So I'm going to try to get out even a little bit before. Okay, anyway. I
So they
love
have to
it.
start
I
right
love
now.
Keynesian beauty contest. Yeah, I love Keynesian beauty contests.
Uh,
So when's the bet? What's the deal?
okay, so the day the CPI releases, the close of it, is that up or down from right now?
Ooh. From right now?
Yeah.
Yeah.
From the close today.
I
say
have
down.
to. I mean, we can't all pick a different thing, right? I guess.
Well, we
could
have
pick
up, down, or
flat.
sideways. I mean, this is the penultimate question, isn't it? Up, down, or sideways?
That's what everybody wants to know. The problem is I know Girk wants down, but I want down too.
You guys can both take down. I'll take sideways.
Ooh.
Wait, hold on,
No
hold
bet
on.
on up.
Ron
We're
gets
gonna
up.
get
Ron
trounced.
gets up. Ron's in this one. He's in the game.
Ron's the
Could be a
tiebreaker.
tiebreaker.
He wants down, but fuck Ron.
Ooh.
He's getting up.
Yeah,
Ron's
Ron's
got
getting up. Too bad, Ron.
He just put up his middle finger. He's confirmed he wants up.
Yeah.
That looks like up to me.
Universal sign for yes.
Double
He's
up?
done two of them now. Yeah, he really wants to
double
go
down. He's doubling down on up.
up.
All right. So we got 2 downs, 1 sideways, and 2 ups for Ron.
Double barrel ups.
All right.
Yeah, it seems like a good bet.
Even
Yeah.
spread.
I like it. Seems like a good time to close this
Do
out.
we want to say how much down or up? No.
No, we don't. We
That's-
picked,
that's
we
for-
picked
that's
a
for-
direction. All right.
That's for Sunday.
We'll say we get a 1% range. Okay, Herb, is that good? So down equals more than 1%, or down or up means more than 1% move, and then flat means within 1%.
Yeah, that's fine.
Okay, cool.
All right. Yeah.
There's the
all right.
bet.
There it is.
My dog wants me to go feed her. She's got dementia. She's always hungry. So
As always, guys, check us out at GammaStrike.com, where you can check out our data product for the options market and also view the documentation.
App.gammastrike